Partnership accounting seems hard at first, but it's really not that different than accounting for a sole proprietorship. We just have to divide up the capital between the various partners. So there's rules about forming the partnership, about income and loss during the partnership, about new partners coming in and old partners going out, and rules about how we divide up the assets at the end. It's really not that complicated. It just seems that way when it's all jammed into one short chapter. So problem 12-3A is assigned. Let's do 12-3B on page 588 of your book. It's very similar, although not exactly the same as 12-3A. So in this problem, we're given a balance sheet up here for the Talus company, and we are to assume that the rule for dividing up the income during the life of the partnership was 5, 3, 2. And at the end, when we wind things down, we're going to sell our assets and get $57,000 for them. So the first thing it asks us to do is to prepare a schedule of cash payments. This isn't a financial statement, it's just a tool that we use to keep track of things. So if we receive $57,000 cash, that means that we must have had a loss on the sale. And how do we get that? Well, if our total assets are $100,000 and cash is $30,000, that means the other assets must be on our books for $70,000, which means that when we sell them for $57,000, we must have a $13,000 loss. So on our schedule of payments, we have a $57,000 cash being received, and we have to divide up that $13,000 loss between partners L, A, and O. We look at the ratio up here. Simple way to do this is to add all these up, put that in the denominator, and then use each of these numbers in the numerator. So 5 plus 3 plus 2 is 10. 5 over 10 is 50%, goes to Laszlo. 3 over 10 is 30%, goes to A. And 2 over 10, 20%, goes to partner O. So after we divide that loss that way, we now have new balances in our balance sheet. We have $87,000 cash. All our non-cash assets have been sold. We still have our liabilities. And now the partnership capital accounts look like this: 28 minus 6,500, 13,650 minus 3,900, etc. One of the ways I like to remember what we do is SARA. Sell assets, allocate the gain or loss, repay the liabilities, then allocate to zero out. So now we've sold the assets, we've allocated the gain or loss, it's time to repay the liabilities. So our total liabilities are notes payable of 20, accounts payable of 30, salaries and wages payable of 2,500. So the next thing we do in this schedule of cash payments is pay those liabilities. Cash goes down by 52.5, liabilities go down by 52.5. So after we do that, we should have new balances. We have $34,500 left in cash. Nothing's happened to the capital accounts because all we did was pay off the liabilities up here. So now all we have to do is allocate what's left. And if you think about it, the balance sheet always balances. So whatever's on the left-hand side of the balance sheet, there's $34,500, equals what's on the right-hand side. So when we zero it out, this should go to 0 on this side, and each of these go to 0 on that side. So when we use the final allocation, what we do when we distribute the cash is to use their capital account balances rather than their income ratios. That way we're sure to zero out the right-hand side of the balance sheet, and that's where we're headed. We want to have 0 left on the left and 0 left on the right. Alright, so this is the schedule of cash payments. But really what we're concerned about in this homework problem is also creating the journal entries. So the first thing we have to do is use our receive cash for selling our assets. Cash goes up by $57,000. Allowance for doubtful accounts had a credit balance, so we debit it to zero it out. Accumulated depreciation had a credit balance, so we debit it to balance it out. Then over here, accounts receivable had a debit balance, so we credit it for 25. Inventory had a debit balance of 35, so we credit it for 35. And equipment had a debit balance of 20, so we credited for 20. And sure enough, to make that journal entry balance, we end up with this loss on sale for 13, which is what we thought it would be. In other words, $70,000 worth of assets sold for $57,000. All right, why don't you pause the video now and see if you can figure out the journal entry to allocate this loss on sale to the capital accounts. All right, hopefully you pause the video, and now we're going to come back and we're going to take that $13,000 loss on sale, which was a debit. We're going to credit it to zero it out, and then we're going to give it to each of the partners. L is going to get 50%, A is going to get 30%, and O gets 20% because that's their rules. 5 over 10 is 50, 3 over 10 is 30, and 2 over 10 is 20. That's how we allocate that. Now we also have to take care of paying off the liabilities. So see if you can pause the video for half a second and pay off those liability accounts, these liability accounts here, which have credit balances, with cash. So notes payable had a credit of 20, so we debited for 20. Accounts payable had a credit of 30, so we debited for 30. Salaries and wages payable had a credit of $2,500, so we debited for $2,500. Cash is an asset. Assets decrease with credits, so we credited for $52,500. And lastly, as far as journal entries go, we have to post this stuff to the partnership accounts. So in other words, we have to zero out the partnership accounts. So we take all the cash, which all that's left is $34,500, and we give it to Laszlo for $21,500, A for $9,750, and O for $32,50. And that zeroes out the left-hand side and the right-hand side. Then all we have to do is post these various journal entries to the various T accounts, and we see that cash zeroes out. We post these journal entries to the partnership accounts, and they're going to zero out as well. So this is our beginning cash. This is the cash we got from the sale of the assets. This is the cash we got when we paid off our liabilities. And this is the cash when we distributed it to the various partners. This is the beginning capital account here. This is the loss on the sale of the assets. And this is the final cash being distributed to the partners. So that's really all there is to winding down a partnership. Like I say, I like to remember Sarah. Sell the assets, allocate the gain or loss on the sale of those assets using the income ratio, repay the liabilities, you got to pay back everybody you owe, and what's left we allocate to zero out to the various partners so that their capital accounts are all zero when we're done with the business. All right, good luck on problem 12-3A.